All right, today we are diving deep into one of the most talked about public offerings in the logistics space right now, the Shadowfax IPO. We're going to break down what this company actually does, the numbers behind their big market debut, and the key arguments, both for and against, that every potential investor really ought to understand. Just think about the last thing you ordered online, that final, super critical journey from some warehouse to your front door. That's what we call the last mile. And believe me, it is a fierce, competitive battleground. Today, we're taking a close look at a major player in that race as it steps into the stock market spotlight.
So, who exactly is Shadowfax? Well, the company is a huge piece of what's known as the third-party logistics or 3PL ecosystem. Basically, think of them as the engine that powers the deliveries for so many of the e-commerce and quick commerce brands you probably use every single day.
At its heart, Shadowfax is a tech-first logistics company. They handle the express deliveries for your online shopping, the hyperlocal or same-day stuff for those I-need-it-now moments, and even reverse logistics. The whole process of handling returns when that thing you bought just isn't right. They really specialize in that final, most complicated, and frankly, most expensive part of the whole delivery chain. And their scale, it's absolutely massive. We're talking a reach that covers nearly 15,000 PIN codes, all supported by over 3.5 million square feet of operational space. This is not a small startup. It's a huge footprint that really cements their position in India's booming e-commerce logistics market.
Okay, let's move on and see how all of that translates into their initial public offering. We're going to break down the key numbers that every potential investor should have on their radar.
The big headline number is 1,907 crore rupees. This is the total amount the company is aiming to raise from the public markets, and it's a pretty substantial figure that definitely signals their big ambitions for the future. Now let's look at how that total amount is split, because this is important. A little over half, about 1,000 crores, is a fresh issue. This is new money coming directly into the company's bank account to fund its operations and expansion. The other part, the offer for sale, is where existing shareholders are cashing out some of their stake. It's a really crucial distinction for investors to understand. Is there anyone tracking this closely? Here's the timeline to keep in mind. The issue opens up for subscription on January 20th and closes just 2 days later on the 22nd. By the 23rd, you'll know if you've been allotted any shares, and then the big day. The company officially lists and starts trading on the stock market on January 28th. So, what's all the excitement about? Let's unpack the bull case for Shadowfax. This is all about the powerful growth story that has really captured the market's attention. The company's prospectus makes a very bold claim. It says it's the fastest-growing third-party logistics company of its size in India, and that's measured by the sheer volume of shipments it has handled. This right here, this is the foundation of their whole pitch to investors. And wow, this chart just illustrates that point perfectly. Back in fiscal year 22, Shadowfax handled about 8% of the e-commerce shipment market. Now fast forward to the first half of fiscal 26, and that number has just exploded to 23%. This isn't just growth, people. It's a dramatic capture of market share from their competitors. And you can see that translating directly to their revenue. A 68% year-on-year revenue growth in the first half of the fiscal year is, according to the data, the highest among its listed peers. That is a number that is just hard to ignore, and it's a central pillar of the company's story right now. But, every story has two sides. Now we have to talk about the number one concern that analysts have been raising, the price. Is this incredible growth story coming at too high of a cost for new investors? And here it is. This is the number that's causing all the debate, a price-to-earnings ratio of 1,018. What that means essentially is that investors are being asked to pay over 1,000 times the company's annual earnings per share. No matter how you slice it, that is an exceptionally high figure by any market standard. And hey, you don't have to take my word for it. Market analysts have been pretty direct, with some calling the valuation extremely exorbitant. This isn't just a small worry, it's the central point of caution for a lot of observers who are looking at this IPO. Okay, beyond just the valuation, there are other key business fundamentals we need to look at. Let's dig into where their revenue actually comes from and see how Shadowfax really stacks up against its publicly listed rivals. This is a really crucial point, client concentration. Nearly half of all their revenue comes from just a single client, and almost 3/4 comes from just their top 5. This heavy reliance creates a pretty significant risk. I mean, what happens if they lose just one of those major accounts? It could have a huge impact on their bottom line. It's a classic challenge for growing companies in the space.
And here's a quick head-to-head comparison. While Shadowfax's growth rate is absolutely on fire, its current scale, when you look at revenue and profit, is smaller than competitors like Delhivery and the established leader Blue Dart. It really is that classic story. You've got the high-growth challenger going up against the larger, more profitable incumbents.
So, when you put it all together, how should you think about this company? Not just for the IPO, but for the long haul. And let me be clear, this isn't about giving advice, but about giving you a framework for your own analysis.
It really all boils down to this one fundamental tension. On one hand, you have this incredibly compelling high-octane growth story. But on the other hand, you have a valuation that many people think is stretched pretty thin. The entire investment thesis here really rests on whether that future growth can justify today's premium price.
So if you're going to be tracking Shadowfax after it lists, these are the key questions you should be asking. First, can they turn all that high growth into sustainable, long-term profitability? Second, are they actually making progress in diversifying their customer base to lower that concentration risk? Third, can they keep growing their market share against some very tough competition? And finally, will we see steady, real improvement in their operating margins over time? These are the true tests of the business.
And that leaves us with the final, critical question. Is Shadowfax the next big disruptor, whose incredible growth will make early investors look like absolute geniuses? Or will the harsh realities of a competitive market and the simple need to make a consistent profit bring its high-flying valuation back down to earth? That is the story we will all be watching unfold.